Have you ever asked what in daylights is a dividend snowball effect? Well, you better stay tuned because I'm going to talk all about that today. Hey, Frank Thomas here from Wealth Generation Strategies, and today we're going to be talking about the phenomena called the dividend snowball effect. Now, this is a really particularly interesting effect. It centers around purchasing dividend-based stocks. A lot of people will say to me, Frank, why are you bothering with dividend stocks? They're only paying 3%, 4%. It's not very exciting. If I was looking just at the stock price as well, the stock price goes up, the stock price goes down. You just can't depend on that stock price. Over time, of course, it does go up. But in the short run, and when I say short run, it could be a 3 or 4 year span, it might go down. So you can't really depend on the stock price if you're looking to reap a reward in retirement for that. Dividends, though, are a different animal. So today we're going to be analyzing how this works. And you better stick right to the end because I'm going to show you 2 ways to supercharge your efforts if you want to take advantage of the dividend snowball effect. So be sure to stay tuned right to the end for that. Let's get into this. When you look at a dividend stock, essentially a dividend stock is a company that has stocks and they will pay a portion of their profits to their stockholders. And they pay it could be on a monthly, quarterly basis, could be yearly. Within my own business, I pay dividends out in my own business on a yearly basis. The company that we're going to be actually looking at as an example, which is Coca-Cola today, is a stock that pays out quarterly. So 4 times a year, it pays out a dividend. If you look at the actual value of the dividend, again, like as I mentioned right in the beginning, it's not very exciting. And if you look at the price, it even gets a little more depressing. But overall, the value of your portfolio will go up. What I've done is I'm going to be showing you some numbers on the screen here today. In those numbers, you're going to be seeing a few different things. One of them is we're going to be looking at $1,000 that we started inputting 25 years ago. 25 years is a good time frame. Even if you're coming close to retirement, I'm hoping you're going to live for at least 10 to 15 years into retirement. So that really counts, and you'll see why in the long run here. Over the term of the stock, there's something called banking on growth stocks or banking on stocks that are going to grow over time in value. If they don't pay dividends, now that's another way how shareholders can make money from their stocks, is the value of the stock. A company like Coke really depends on its dividends for the shareholders, even more than the actual value of the stock itself. That's an important point to remember. If you look at a lot of the dividend aristocrats and the dividend kings, these are stocks that have been paying an increasing dividend for at least 25 to 50 years, will really look at their profits for their shareholders in their dividends, and they really want to raise those dividends up every single year. And normally a stable stock like Coca-Cola, for example, will look at doing every March is the first time in the new year that they will issue a dividend, and they'll raise the dividend a little bit every single year. And they've done that, even in the 25-year window I looked at, they've done it over and over again. Don't get sideswiped here on the fact that in the early years, in the early 2000s, they actually did a 1-to-2 split. So in other words, if you own one stock, it became 2 stocks. The value got cut in half on the stock, but the dividend also got cut in half. So it looks like you're losing money, but you didn't lose anything, because if you owned 50 stocks, after the split, you owned 100 stocks. So essentially, you're making about the same amount of money. Now, the only reasoning that I can put behind this, I don't work for Coke, so I don't know the reasoning. But the reasoning I can see is they want to continue to make the stock affordable for the average Joe to buy. A way to do that is to split it. And they basically double the shareholding and decrease the value of the shares by cutting them in half, but increasing the shareholders' number of shares by doubling them, so nobody loses anything in the long run. So just so you know. Depending on the price alone, if you looked at Coke, it would be a little depressing. From 1999, when I started watching it in March of 1999 to March of 2024, which that's the month we're in right now, the price of the actual stock has gone up, considering even the split, almost 100%. It was around $63 before the split at the beginning. Now the stock is worth about $120 or pretty close to it. So if you're just looking at the price has gone up, which is good. You want to see that. But in the long run, that's not what you should be depending upon, especially if you're buying dividend stocks. Now let's look at the second thing, and that is that increase in the actual dividend amount. That's what's important here. Now, what I did was I looked at the actual price over 25 years. I took the real prices. I based an account of $1,000, and I'm going to put the numbers on the screen right now. Based an account of $1,000, and what I was doing is I was using what's called a DRIP. And what a DRIP does is if I have enough money, when they go to pay out the dividend, if there's enough to buy any stocks, they'll buy the stocks first, and I don't get charged a handling fee for that. Coke just buys it automatically for me, and they don't pay that dividend out. They just give me another stock or another 2 stocks or whatever it is. They just plunk the remainder into my account, and then I have to do something with that if I want to. Over time, that dividend is going to increase. Now, here's the really nice thing. I found on average, that dividend went up between about 4 or 5% up to 20% every single year. So it's definitely keeping up with inflation. If anything, it's allowing you to build your portfolio. Let's say you have a budget and you've decided I need $5,000. And let's say you set up your account 25 years ago that you've got enough Coke stocks that it's going to pay you your $25,000 or your $5,000 a month in dividends, whatever that is. And over time, every single year, it will go up with that 3% inflation. Now, you will say to me, well, Frank, inflation went up over 9% last year. You're absolutely correct. But if you look at the average inflationary rate over 25 years, it's about 2.8, 2.9%. I say 3% just to be really, really safe. Over time, you're getting little incremental raises. Now, that money can go to 2 places. One of them can be rolled back into your fund to grow your fund. Or the second place is it becomes a little more money in your pocket and you can have more fun and do more things in life. It's up to you. Now, the third thing here is what we've been talking about all along, is that reinvestment of dividends. And this is when you really start to see the rubber hit the road, because you get a compounding effect. So basically, here's your stocks and you get a couple little dividends. Now you're getting dividends the next time on this amount and this amount and this amount. The whole idea is over time, you're going to increase the actual amount of dividends you're going to be obtaining in the long run. And in the beginning, I only had, for this $1,000 account, I was only able to buy 15 shares. Over time, between the rise in the actual share price and the number of shares I was able to buy, in March of this year, I would have had from that 15 shares, 60 shares. That makes a big difference. The dividend amount that was paid out on a monthly basis from that initial $1,000 started out at $2.40 every quarter, which is not terribly exciting. But in the end, it was paying out almost $30. It was actually $28.62, which is starting to get exciting. If you have a lot of money sitting in there, let's say you have $500,000 sitting in there, this is exponential. The effect is the same regardless of the amount in terms of percentage increase. The big difference here is how much you're going to get paid. So over time, you would have started out, let's say you had built your budget, and let's say you only needed $2.40 to live in 1999, which is totally impossible over the course of a quarter. But just run with me here on this one. In 2024 of March, now you would be up to $28.62. And I equate that over time, you're seeing, like I said, anywhere from about 4 or 5% and as high as 20%. On average, it was about 10%. So there's a strong possibility that you're going to be able to reinvest. If you only need 3%, you're going to be able to take 7% of that 10 and reinvest it back into and purchase more stocks. So you still are going to increase the value of your portfolio and still live just as you did last year and the year before. And you're also equating for inflation. Before we get to our bonus, I'm just going to ask you quickly, if you're enjoying this video and you're getting something out of it, I hope you are, because this is a very confusing topic and I hope I'm explaining it well. And if you feel that I am, subscribe. Join the tribe here at Wealth Generation Strategies, and I promise to share as much information that makes sense as physically possible. So subscribe. Let's get into our bonus. As I mentioned in the beginning, there's two things you can do to supercharge the effects of your long-term dividend snowball strategy. One of them is diversification. Some stocks will go up where other stocks will go down. Stocks prices will fluctuate. That's the way it is. I remember somebody had said to me once that the stock market is like a crazy man. One day he wants to sell you something that's totally overvalued. It's way too expensive. And the next day he'll come to you and he's trying to sell it to you at half price. That's the stock market. So over time, you want to diversify and have different stocks. One stock like Coke might be going up, whereas let's say Manulife is going down. So you want to have a portfolio of 5, 10, 15, 20 good long-term stocks in your portfolio. That way, you're also covering against what can really be bad is, let's say a company folds and they close their doors. Now, we are going to try to invest into dividend aristocrats and dividend kings over the long term, because those are the companies that have some real staying power. And you're also trying to invest in the companies that you recognize their brands. Procter & Gamble. Look at the back of your shampoo. Look at the back of your toothpaste. Who made it? Probably P&G, Procter & Gamble. You get your sticky tape from 3M. You get your Coca-Cola, your Pepsi-Cola. You go to bank in Canada, the Bank of Montreal or the Royal Bank of Canada. You get what I'm getting at here? You're looking for companies that have staying power. So you're minimizing your risk, because all stocks have risk. All investments have risk, and you got to remember that. But the greatest risk is not doing anything, because inflation will slowly erode the value of your funds. So you have to stave that off as well. So you got to do something. That's why I love the dividend snowball effect. So diversification definitely is number one. Second one is what I recommend to everybody is, even if you invest a chunk amount, let's say in 1999, I put my $1,000 in and let's let it roll, baby. Over time, we will want to continue every payday, make it habitual that you put it on your budget. You got a budget, right? Right? Put it on your budget that you are actually putting away more. In other words, you're buying more stock every single payday. It could be that you put $50 every payday, or 100, or 1,000. It's up to you what you do. The more that you can, the better it is for you. My recommendation is, if you find that you can live within the confines of a certain amount, let's say my household will run very effectively at around $6,500 a month. That covers all expenses for the month. If I make $10,000, or let's say $8,000 or $9,000 after I pay the taxes on it, I will take that difference and put it away into investments. Sometimes I'll put it away into an emergency fund, but I'll also put a majority of it away into investments. So that is my long-term plan, and that will really supercharge your efforts. I tell you, you put away a little bit every month and you'll be shocked over the long run what it turns into. So I hope you've enjoyed this video. You'll see another video, which I did last week, that talks about if you're on a low income, how the daylights can you save? If you're in this situation, be sure to check that out. You'll see it on the screen right now. If you do, we'll see you over there. If not, well, thanks for joining us today. And like I mentioned earlier, if you've enjoyed this video, give it a thumbs up or subscribe. Frank Thomas will talk to you later. Bye-bye.